Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi there, welcome to Better System Trader. Today I want to share with you a bit of insight into optimization from Perry Kaufman. The reason why I'm sharing this one today is that I was reading an article on a popular trading website and the author was making some assumptions based on the optimization results which may not have been entirely accurate. Now, I'm not going to mention the website because that's not the point of this, but I think a lot of traders can get caught up making this same assumption. I know I definitely have, and it's sometimes good to be reminded of these type of things so that we don't make the same mistakes. So I'm going to play you a couple of minutes of audio from Perry now, explaining what this assumption is, what to look out for, and how to address it. So let's hear from Perry.
So let's go on to what you were talking about, which are how do you pick the parameters to test?
Yeah.
First, I believe you have to intellectualize this before you even start. In other words, let's say you have a moving average system, a simple example. You could start with a 1 day or 2 day moving average and test everything up to 250 days, one at a time. All right. That means that you have no clue what's likely to work. And you're trying to let the computer tell you where the best parameters are. I think that's the wrong way to start. For example, I believe that trend following works in the long term, not in the short term. That is, conceptually, I think there are short-term trends caused by supply-demand and some movement as reaction to various news items. But the real trends are the ones created by the Federal Reserve or the central bank when they raise rates slowly or lower rates slowly. And those trends are long-term. They apply first to the interest rates where they originate, next to FX, because money flows to those countries that have the highest yield net of uncertainty. Sometimes uncertainty is inflation, sometimes it's just government instability.
Yeah.
And then lastly, it flows to the stock market. But I believe all of those are longer term periods. I think you can simulate a typical macro trend system used by the CTAs with something in the order of 80 days. So a 5-day moving average is not likely to work. 10-day worked in the 1970s nicely, doesn't work anymore. And so you need to decide first, am I a long-term trader or am I a short-term trader? And if I'm a long-term trader, I need to use a range of moving averages from, say, 40 or 60 to 120 or to 250. You need to pick that range in advance of testing because, as I said, you need to be validating your idea, not trying to find out what works. And when you select these ranges in advance, you're validating your concept. So let's say I'm doing a long-term moving average and I pick 60 to 120 as my range, 60 to 150. Now, how do I test that? Do I test every one of those days from 60 to 150? Do I test every 5 days? First, I don't test every day because it's just too much information and unnecessary. On the other hand, the percentage difference between a 60 and a 65-day moving average, or 65-day period, and the difference between 100 and 145 and 150 days is quite different. So clearly you're getting very little change when you go from 145 days to 150 days compared to 40 to 45 or something like that. So when you're done with your testing, it's going to look as though the higher numbers, the higher calculation periods, are much more stable because the returns don't change much at that level because the percentage difference in the calculation period is small. I mean, the obvious difference is going from a 10-day moving average to a 100-day moving average. 9 to 10 or 10 to 11, you're changing by about 10%. When you go from 99 to 100, you're changing by 1%. The results will fool you if you use this linear distribution. So when I do a rough test, I might do 30, 60, 120. And it's only 3 tests, but each one goes up by 100%, and that gives me a much better feel for it. You could go up by 50%, 30 to 45. But I suggest if you're able to do that, to increase your time period, your calculation period by a percentage, not by an absolute increment. And you'll find that not only will you have fewer tests and fewer results to look at, but you'll be getting a much more realistic distribution, and you won't think that the slow end is the best because it was most stable.
That's interesting. I think I know that I'm definitely guilty of testing a linear approach like that, and I think a lot of other traders are. So I thought that was quite interesting that you raised that problem and bring some awareness to it.
Let me just interrupt you yet again.
Sure.
And tell you that, practically speaking, most test platforms don't allow you to do this. If you're a good programmer, you can manipulate the test platform to do it this way. But all you really need to do, if you have time, if you can do it, is run your test using these equal increments and then just extract the periods that go up by a percentage and move them to another table so that you can see just the results you want to see and not be distracted by the others. It's going to be the easier solution or the most practical solution.
Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.